Howdy, folks. Happy Friday. It is Friday, October 11th, 2024. Hope you're having a fantastical day and welcome to Liberty Call. It's a beautiful day here again in Colorado. A little overcast earlier today and a little chillier, but again, it's not hot like Texas. And we got electricity like unlike Florida. So anyways, hope you're having a fantastical day out there in the interwebs. If you could do me a favor before we jump into all the numbers, give me some thumbs up, a like, share, subscribe, and follow, and press that notification bell. Okay, let's see how the markets did today. Looks like domestically things were pretty good. Lots of green on my screen all day. Dow Jones was up 0.97%, 409 points, closed at 42,863. S&P 500 up 0.41%, 23 points, closed at 58.15. NASDAQ up a third, 59 points, closed at 18,341. VIX was down 1.92% today. It's at 2046. Canada up 0.7, Brazil down 0.27, and Mexico up 0.09. In Europe, Germany was up 0.75%, the UK up 0.19, France up 0.48, Netherlands up 0.51, Spain up 0.54, Italy up 0.68, Switzerland up 0.64, and Portugal up 1.04%. Russian exchanges were split today. The MOEX down 0.32, RTSI up 0.9%. And the overnights, the Nikkei in Japan was up 0.42%, Australia down a tenth. New Zealand up 0.58%. In China, the Shanghai was down 2.55%. The Shenzhen component down 3.92%. China A50 down 2.2%. DJ Shanghai down 2.81%. The Hang Seng, when it closed on the 10th, was up 2.98%. And the Taiwan weighted hasn't been open for 2 days. All right. So overall, pretty good day. You know, things were more robust here domestically, it looks like, but not too bad. All righty, let's bring up our chart and see how we did for the week. Let's get those off and go to the 1 week. Come on, there we go. All righty, starting out with the Dow Jones. It's going to finish the week in the green, up about 1.21%. The S&P 500, about 1.06%. The NASDAQ, up about 1.14%. The Dow Utilities, that one's going to be red, down 1.86%. And the Dow Transports, there we are. It's going to finish in the green, 2.69%. So looks like that's the best one out of the 5 major indexes I have here on my chart. So, all righty. So 3 or 4 out of the 5 were in the green, which is positive. So let's go back and take a peek and see how our markets are doing. Let's zoom in here. Let's do the whole year. All right. So starting right here is January. So we can see kind of flat first half of the year, followed this trend line. Then we had the secondary trend line, which trended up. And, you know, you can see these bounces off of this, and it bounced most recently here on the 8th, on Tuesday. So again, I was kind of curious, are we going to, crash through this, or is it going to bounce off and continue the upswing we've been on? Let's go to the S&P 500. We can see here that we had a little bit more of an uptrend in the S&P. Same thing with the NASDAQ this year, mostly due to the hope that interest rates were going to start going down sooner than later. So those had a little bit more of an uptrend. Broke the uptrend, like I said, in the summertime. And then we were in this downtrend, which we broke on August 15th. And since then, we've bounced once. And then if we zoom in again, came pretty close to bouncing the 7th and the 8th. So, these charts, more recently have really, kind of correlated more. And so we'll see what happens with, obviously we've got the election coming up and all that nonsense. So we'll see. All right, get that off my screen. All righty, well, let's get into the economic data that came out this week. Starting out with jobs, initial claims came in at, or initial jobless claims came in at 258. Forecast was 231,000. Previous number was 225, so a big jump there. Continuing claims came in at 1.861 million. Forecast was 1.83, so about 31 over forecast. Previous number was 1.819. Trade balance came in at a $70.4 trillion deficit. Forecast was 70.1. previous number was 78.9. So the deficit improved, but it still was worse than the forecast. The Consumer Price Index came out this week. Annual growth year over year was 2.4%. Forecast was 2.3, so a little hotter. And the previous number was 2.5. Month over month, it grew at 0.2%. Forecast was 0.1. Previous number was also 0.2. U.S. Federal Reserve balance sheet is currently sitting at $7.047 trillion. So peaked out around about 9-ish at its peak, summer of 22-ish. And so they've gone down a whopping $2 trillion. So they still own a lot of assets that are pretty much garbage. So we'll see what goes on there. Producer Price Index year over year grew at 1.8%. Forecast was 1.6. Previous number was 1.9. And the month over month was flat, zero growth. Forecast was 0.1. Previous number was a 0.2. And the last bit of data, the Michigan Consumer Sentiment came in at 68.9. Forecast 70.9. Previous number was 70.1. All right, so that's all the data that's fit to be told for the week. Y'all feel good? Feel smart? Feel educated? I know I do. All right, let's get into the market recap for today. S&P 500 tops 5,800 for the first time ever as Wall Street banks kick off earnings. All right, S&P 500 rose on Friday, surpassing the 5,800 mark for the first time as major banks like JP Morgan Chase and Wells Fargo kicked off the third quarter earnings season with better than expected results. Both banks exceeded profits and revenue forecasts, boosting their stocks by 4% and 6% respectively. The positive earnings fueled optimism about the U.S. economy, and all three major indexes, the S&P 500, Dow Jones, and NASDAQ, are poised to close for their fifth consecutive week of gains. In contrast, Tesla's stock fell over 7% after its crypto cab robotaxi unveiling, which disappointed investors due to its limited details on technology. Meanwhile, Uber benefited from Tesla's lukewarm reception with its stock surging 9%. Stellantis also slipped nearly 3% after announcing executive changes, including the upcoming retirement of CEO Carlos Tavares in 2026. Well, that's a year plus from now. Inflation data from the Producer Price Index showed no change in September, and the annual rate slowed to 1.8%, hinting at cooling inflation pressures. This aligns with recent consumer inflation data, which was higher than expected, suggesting a mixed inflation outlook. Traders are now anticipating a 25 basis point rate cut in November rather than the aggressive 50 basis point cut made in September. Comments from the Federal Reserve officials like Atlanta Fed President Raphael Bostic have fueled speculation that a rate hold could be possible in November. While a slower pace of rate cuts might pressure stocks, which have reached record highs, partly on expectations of substantial rate reductions, the cooling inflation signals some stability. The cooling inflation signals some stability in the economic environment as the market braces for upcoming earnings reports from major financial institutions. So everyone's in a giddy mood this Friday. All right, so let's dive into some data. September PPI report. This is from First Trust. Mr. Andrew Opdyke put this together. In September, producer prices remained flat, fueling expectations that the Federal Reserve will cut interest rates by 0.25% next month. However, concerns linger over persistent inflation, particularly when volatile components like energy and food are excluded. The core producer price index, which removes these volatile categories, increased by 0.2% in September and is up 2.8% over the past year compared to 2.3% in the previous year. The stability in headline producer prices rising just 1.8% over the past year has partly been due to declining energy prices, which dropped by 5.6% in September. But with recent increases in energy costs, this effect may reverse in October. Service prices played a significant role in September's core inflation, up 0.2% for the month and 3.1% for the year. This broad-based rise in service costs underlines ongoing inflationary pressures within the segment. In contrast, good prices fell by 0.2% in September, driven by declines in items like gasoline, which offset rising costs in motor vehicles, chicken, and electricity. Chicken, huh? Further along the supply chain, intermediate and unprocessed goods saw notable price declines of 0.8% and 3.2% respectively. Future inflation trends will likely be shaped by the service sector, which has rebounded post-COVID, and changes in the money supply. The M2 measure of the money supply, having surged in 2020 and 21, peaked in early 2022 and remains down 2.5% since then. Well, it went up 40%, so I don't know if I consider a 2.5% reduction, that dramatic. If M2 growth accelerates sharply, inflation could increase once again, raising questions about whether the Fed can maintain a balanced approach to easing. The Fed's next steps will be crucial as they navigate these inflationary pressures amidst economic uncertainty. All right, so based on First Trust's view, inflation could continue to trend downward, or it could go the other way if energy prices really start to spike. Good news. All right, one last article here for the week from Zero Hedge. Is the inflation dragon really dead? And this was written by Philip Mary, a senior U.S. strategist at Rabobank. Following recent economic developments, investors are cautiously anticipating market activity. U.S. stocks declined on Thursday as markets responded to inflation data exceeding expectations. The consumer price index dropped to 2.4%, slightly above forecasts, while core inflation edged up 3.3%, signaling persistent inflationary pressures. This has led some to speculate that the Federal Reserve may take a slower approach to rate cuts. Notably, 3 Fed officials, including John Williams, Austin Goolsbee, believe that inflation is trending downward. Well, I would expect that for Mr. Goolsbee. He is a fool. Suggesting that rate cuts may continue. In contrast, Raphael Bostic from the Atlanta Fed expressed openness to pausing rate cuts if warranted. Mr. Bostic is a little more cool-headed, just in my own observations of reading stuff from his opinions over the years. Meanwhile, attention is on the Middle East as tensions persist about a potential Israeli response to Iran impacting global oil prices. China is also in the spotlight with an anticipated fiscal policy update as investors hope for a significant stimulus package to boost the economy. Because, free money is always what helps the economy. On the global stage, France's new budget proposal presented by Prime Minister Michel Barnier targets a deficit reduction of 60 billion euros. However, with no parliamentary majority, there are concerns the proposal may be watered down. Rating agency Fitch has already hinted about a potential downgrade to France's AA negative rating, given potential instability and optimistic projections for deficit reduction. Should the downgrade occur, the markets appear to have largely anticipated this move, limiting immediate impact. Overall, the current economic landscape remains fluid, while inflation, fiscal policies, and geopolitical events driving market sentiment as investors navigate these challenges. So I guess, in the Cliff Notes version, you got 3 Fed officials. 2 say we should probably continue the Fed cuts. And then Mr. Bostic, who's a little more rational in his view on things, believes that, if we need to pause, we need to pause. I'd like to hear him say, well, if we need to start raising rates again, we'll have to do that too. So we shall see. All right. Well, that's everything that I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. Doodle-doo-doo-doo. All your financial planning needs can be addressed there, so feel free to give me a buzz. All right. Well, I hope everyone out there has a fantastical weekend, and I shall talk to all y'all again next time. Adios.